I'm Joanna Simpson here at Risk Minds International in London. Joining me now is Hanna Sarraf, Chief Risk Officer at Monzo Europe. Thank you very much for joining me today. And having worked at both a traditional bank and digital first banks, what are the greatest differences that you've observed when it comes to risk management? And are there any practices used on one side that you think the other could benefit from?
Thank you. So I think from my experience, the most striking difference between traditional banks and digital first banks is how embedded customer centricity is in the risk management frameworks of digital first banks. And let me elaborate a little bit more about this point. So what digital banks do, they leverage the customer-centric business models they built to align all the risk management practices, whether it's strategies, assessment, measurement, reporting, into how they achieve customer outcomes and experience. Basically, you link risk management to customer outcomes and experience. And to give you an example, at the top of the house, if you look at the board and the board terms of reference, they explicitly call out the oversight of customer-centric risks and making sure that this is the top of the governance agenda. And some banks go as far as setting up and establishing board-level customer committees so that it looks at customer expectations, customer satisfaction, customer needs. And some banks go even further, and now we're seeing some roles around first line of defense, like chief customer officers. It's all targeting and dedicating to the customer needs and experience. But then you take it further from a risk management framework perspective. You look at risk culture, risk appetite statements. There are explicit statements out there that call out the organization's vision for delivering good customer outcomes and experiences. And that in itself sort of trigger further down on the risk appetite by having specific metrics that are quantifiable measure of good customer outcomes. And that goes into a board-approved statement that cascade down to the organizations with direct link to incentive compensations of people. So that when you look at the balanced scorecard from a performance management perspective, it's not all about financial metrics, but also it's non-financial metrics. And one of those non-financial metrics is customer centricity. And then you can take it further to risk management assessments or practices like risk assessment processes. What I found it very interesting in the digital first banks is that they flip the problem around risk assessment from being siloed, vertically integrated risk assessment process, which is essentially looking at any particular risk category or function. You could have a compliance risk assessment, a fraud risk assessment, an IT risk assessment. But then you find yourself into this whole sea of risk assessment and you kind of tend to miss wood for the trees. Whereas the digital first banks, they try to flip the problem around and say, actually, we're going to pick a process and we're going to run in a process-based risk assessment, which essentially look at the entire customer journey end to end. And that allows them to identify the risks and the controls at different touch points to the customer with the entire process across the organization, whether it's a lending process or saving or payments. So the interesting bit about this is it allows the identification of interconnected risks, any particular concentration of risk, but also gives you the holistic view of risk of a particular process along the customer journey. And then lastly, in my favorite point really is which I used to call the holy grail of risk management, is having all the data in one place. So you have a centralized data platform where all the risks around the customers are in one place. So you really have 360 view of risks in one place, allowing you to pull out the customer ID and check around that ID, what are the risks attached to that customer from a KYC, fraud, money laundering, or even payment behavior, any risk around deposit attrition. You could even look at credit score all around the same customer ID. And imagine what this can do if you start aggregating other customers' ID with similar profile. Now you have a segmentation pool that you can use to refine your risk management strategies, but also allowing you to offer maybe hyper-personalized products and services to your customers, or indeed have more relevant content in the way you interact with your customers.
And how do you foster a culture of risk assessment among employees in a fast-paced, technology-driven environment?
Yeah, I mean, fostering a culture of risk assessment among employees is important on the basis that it has to be embedded in the kind of the very DNA of the organization, but at the same time keeping the balance with innovation and agility, right? So there's always this kind of point where risk culture and risk awareness has to be embedded, but at the same time without impeding the innovation and agility. And I'll give you some considerations. So for example, when you look at how digital first banks or neobanks nowadays, the kind of the new generation of banking, when you look at their strategy statement and the mission statement, the values they have, you establish a direct link between customer awareness and the strategic objectives and goals of the organization. So at the very top of the house, when you launch a strategy, so we're going to be, this is our mission. The risk management statement isn't that mission. So at the top of the house, it's linked to strategy. So it shows how risk management can deliver a better customer outcomes. It also shows how risk awareness actually is fundamental for the organizational resilience to be able to continue to deliver customer outcomes in the event of, let's say, a stress event or disruption. So that gives confidence to customers, it gives trust, gives loyalty. Secondly, make risk as a shared responsibility. So in the old days, risk management used to be a function or a department or a team sitting somewhere else in head office trying to do some quantitative analysis. It's no longer the case. Risk management has to be a shared responsibility across the three lines of defense, from the second line, first line, but also across all the processes. So when a bank launches a product, or when a bank decides to take a transaction, let's say M&A, acquiring a business or divesting, any transaction or decision made, risk has to be at the table, and a risk assessment has to be jointly accompanying another assessment. So make risk a shared responsibility. I'd say the third element to that would be tone from the top, right? Like we said, if you establish your risk statement and linking it to strategy, and finally, so it really has to be part of employee journey and making sure that when employee onboard in new organizations, they receive appropriate onboarding and training around the company's values and risk philosophy. As well as making sure that certain values around customer, empathy, transparency, accountability for decision making is all well understood way as part of the onboard an organization, but also a continuous learning and development plan as they continue to grow within the organization.
And how do you avoid friction between dampening the customer experience whilst tightening cybersecurity?
That's a great question. So balancing customer experience with robust cybersecurity measures is a critical success factor for digital banks nowadays. It's really important to kind of get that balance right. Overly emphasizing on the cybersecurity measures and adding a lot of controls might trigger a lot of frictions with the customer, and therefore may decide, I might stick with my own bank. I don't have all that myriad of things. Equally, if you don't invest enough in the cybersecurity measures, you're exposing your customers to risks, right? So it's getting that balance right is really important. And maybe I'll give you some considerations here in terms of some strategies that really work. Secure by design. So when we launch a product and service, as part of that product development process, security measures are baked into it. So it's not after the fact. So once we launch, let's say, a mortgage or credit card, and realize actually, we missed a specific aspect of security, we have to come back to it, then you're creating friction. So by design, secure, but also keep the customer in mind as you are designing the security measures. So what customer wants, something very simple, easy to run, and hassle-free transactions. So if you bake that by design, keeping the customer in mind, it could be something seamlessly baked into the customer journey. Then by doing this, you are delivering protection, but at the same time keeping the customer journey in a way still convenient and without obstacles. I'd say another strategy that worked is when you design those cybersecurity measures, there are different ways of designing those controls. And nowadays, with innovation and technology development, there are contextual type controls, or there are personalized or there are risk-based type controls. So it doesn't have to be a static control that you have every time you be prompted to add your password, for example. You could use multi-factor authentication methods, relying on, for example, biometrics by putting your finger, or you're looking at the particular device. That in itself allows you to have a lot of kind of single sign-on security. At the same time, you're not repeatedly asking for security intervention by the customer, and therefore creating friction. So you could achieve what you want without necessarily creating the friction. Other type of strategies there include, for example, if you look at the customer journeys and where like risk-based controls that are reliant on location, for example, of the user or transaction values. These are specific trigger points which will trigger a real-time intervention. So for those banks that are investing in real-time detection techniques and capabilities, whether on transaction monitoring or whether on just continuous detection of particular events, if you are clear on those trigger points, that will deliver direct and real-time intervention to protect the customers would be much, much more valuable than having a static process that can repeat itself without necessarily achieving the same outcome. So bringing that balance between those two elements, robust cybersecurity measures that are very well designed to be seamlessly embedded in the customer journey and maintaining customer experience, having that balance right is critical for the success of a digital bank in the future.
And what are the unique challenges faced when implementing risk regulation in a rapidly growing digital banking environment?
So implementing risk regulations in rapidly developing technology environments present a number of challenges. So one would be the rapid pace of technology developments that we're experiencing. Every year we meet, we hear more about new technologies, and the pace of that is exponential. Then you have the evolving regulatory landscape, which is also trying to keep up pace with the development of the technology. And then finally, I'd say the unique characteristics of the digital bank business model. So if you take the rapid pace of technological developments, what digital banks have to face is making sure that as they grow, that the risk management and control practices and compliance, they keep up with the pace of growth, but at the same time, as digital bank by design, they are characterized by innovation and always new technologies being used. That in itself not just amplifies certain existing risks like cybersecurity and so on, but they create potentially additional new risk and emerging risk. And one of them recently we've been talking about is for example, quantum computing in terms of encryption risk and what does that do to data privacy and data security. So you have to be able to keep the risk management practices slightly ahead or at least in line with the technological advancements, so you are able to control as you grow as an organization. So that's one set of challenges. The other set is, as I said, the regulatory landscape. The regulators also are trying and striving to keep up with the pace of technological change, and they are introducing regulation, rightly so. However, those regulations tend to be reactive and therefore static in time, and therefore, when you look at the trying to kind of digest the amount of regulatory requirements that you have to comply with as a global digital bank, although the aims most of the time are similar. So take, for example, resilience is a typical regulatory requirements nowadays is in the US, in the UK, and in Europe they're going to introduce the Digital Operational Resilience Act, DORA. So you look at this, you say, okay, well, it's all about resilience, therefore you do it once, you're fine. And actually, no, the devil's in the details. So you go into country by country, jurisdiction by jurisdiction, you have different flavors and different nuances. That becomes of a program of change that you have to deal with as a bank in a kind of holistic way rather than piecemeal by country. And therefore, trying to identify those synergies between requirements is very important. Otherwise, you'll be dealing with each one of the regulatory requirements in a kind of siloed way, rather than see the big picture here is what the regulators really want. And actually, they want a resilient and solid, robust bank. So you keep that big picture objective in mind and then try to get the processes and the practices you have in place to meet this big picture kind of vision. And then I said the inherent characteristics of digital banks. So digital banks inherently are exposed to fraud, cybersecurity risk, but also money laundering, and therefore they have to keep always ahead of the cyber criminals and the cyber environment which is growing as we develop the digital footprint. And therefore there's an element of challenge there to make sure that every new technology being adopted by cyber criminals, that we have at least the mitigating element or maybe slightly ahead of that to be able to protect the bank, but also to recover if in case there was disruptions in that area. So we use behavioral analytics, we use a lot of machine learning and AI to help in that space, use the enormous amount of data that we have to be able to, again, in real time detect any particular risk and so forth. And finally, I'd say cultural alignment. So by that I mean, if you look at traditional banks on one end of the spectrum, and then you have fully native, digitally enabled digital bank, Risk management is common across, but the emphasis on risk culture tend to be slightly different. So when you say, you take a case of a digital bank where by design is being shaped by engineers, software engineers, data and technology engineers, there the cultural focus is more on the controls and the risk and compliance to be a key strength, essentially, to supplement that capability. Whereas on this side of the spectrum, more traditional banks, where risk and control probably is inherently by design, it's the focus of the culture should be more on the innovation and embracing the technology. So it's like slightly different lens, but it's that alignment that is equally important for both. So in summary, if a bank is able to develop risk management and control practices that are taking into account the pace of technological developments that are in line with the regulatory requirements and making sure everything is being dealt with in a strategic way and keep that vision in mind of customer centricity, I'd say these are the key ingredients for success in the future.
Hanna Sarraf, thank you very much for joining me.
Thank you.